Okay, hi everybody. Good evening. Welcome to tonight's webinar. I hope you all had a good dinner. Okay, my name is Abigail. I'm your host tonight. So before we start, I would like to do a sound check as usual. So if you can hear me, please tick the yes in the poll. Okay, I see yes, a very good response. All right. Okay. Okay, so here's a little disclaimer, okay? For whatever we share tonight is just for general information and educational purposes. So it does not constitute any recommendation to buy or sell any investment products. And a little background about our company. So our company is called Phillip Capital St. John Berhad. We are incorporated in the year 1995. So our company has been around for close to 30 years now. And we are a wholly owned subsidiary of the Phillip Capital Holdings. So, and some of you may know we were formerly known as Phillip Futures. But as we grew and expanded our service and product offerings, we have since renamed ourselves as Phillip Capital. And apart from that, we are also a trading participant of the Bursa Malaysia Derivatives, participating organization of Bursa Malaysia Securities, and also a holder of the Capital Market Services license. That basically means that we are a legal and also regulated broker in Malaysia. Okay, so Phillip Capital has offices across Malaysia. Our mother company is actually from Singapore, all right, but our HQ, right, our headquarters is based in KL, Kuala Lumpur, and we have 11 branches in both East and West Malaysia. So we call our branches these Phillip Investor Centers, as you can as indicated by this little piece lah. So if you are from any of these cities, you are welcome to drop by our branches to inquire about investment related services. Okay, and this slide shows the Bursa Excellent Awards that we have received for the past many years. And last year, we are also very honored to be awarded as the first runner-up for the best retail derivatives trading participant, as well as the second runner-up for the best overall derivatives trading participant. Yeah. Oh, sorry. Okay. It's a bit lagging. Hold on, yeah. Okay, so Phillip Capital has a wide global network. We have offices in 15 different countries as located here in the map. As such, we also do serve an international client base. Yeah, and for futures trading, we also provide products listed in global exchanges from the US, like the popular exchanges, CME, CBOT, COMEX, NYMEX, right? We also have exchange from Europe, Japan, Hong Kong, Singapore, and also Malaysia. So with our global coverage, clients can trade both local and foreign products within our same platform. Okay, now onto our products. So we offer three main categories. The first one is futures, which include diverse markets like the equity index, agricultural, metal, energy, and also interest rate futures. Right. The next one is equities or stocks. Okay, you can trade Malaysia shares, Hong Kong shares, US shares, Singapore and Australia shares with us. And apart from just shares itself, clients can also trade ETFs, warrants, and IPOs here. And the third one is the contracts for difference, or also known as the CFDs. We offer local Bursa shares and also US share CFDs. And if you want to trade the US indexes itself, like the Dow Jones, S&P 500, and also NASDAQ, we also offer the CFD at a very attractive rate. Yeah. So if you're someone who likes to take advantage when the market is going down, so derivatives product, right, such as futures and CFDs are actually a great choice because you can short the markets and potentially make a profit. Yeah, so essentially it means you can trade both ways when the market goes up and when the market goes down. Yeah, and you're also able to trade with margin or leverage, meaning your capital upfront is a lot lesser. But if you are more of an investor, or your plan is to invest for the long term, then of course stocks are suitable for you to explore. Our rates for the foreign markets are also very competitive. So if you are interested, do let us know and we will contact you accordingly. Okay, so why choose us as your broker? First, Phillip Capital is an award-winning broker. We are well established and also recognized in the market. Secondly, we also offer 24-hour broking and execution support. If you have issues regarding your trades and account, right, you can call in our dealing desk and we have dealers ready to assist you. Okay, the third one, we also provide advisory services on what products you like to trade or how you can get started. And we also send out latest market news to our clients on a daily basis, so you can be sure to get the latest updates. And as mentioned earlier, our clients can trade a wide array of products through our platform. And lastly, we have an online account opening, which is very convenient for you to start. Okay, so apart from all those, right, we also provide free one-to-one coaching sessions. So if you're like more personalized coaching on how futures trading, for example, or how to use the platform, we can always arrange an appointment to guide you for free. And we also often conduct free seminars and webinars. And you can also start trading by opening the account for free, as I just mentioned earlier also. So for the coaching sessions, right, it's more tailored for beginners who want some guidance on these topics, like how to start trading, about the product knowledge, platform, and charting system. So yeah, if you are interested, we are more than happy to assist you. And at Phillip Capital here, we also constantly provide educational resources for investors. All right, you can check out our upcoming seminars and webinars by scanning this QR code, or you can also visit our website at phillip.com.my to check out the schedule. All right, we invite speakers from the industry to give market updates and insights. So it is a good learning opportunity, I would say. So do join us for our events. Yeah. Okay, so this is for those who trade stocks, right? We conduct this weekly market calls. So you can join our research team on the market views and updates for newly published reports every Monday at 11:15 a.m. Or if you want to learn technical analysis, right, how to spot entry or exits, right, then this is for you. Our analysts will do technical analysis on live counters every Monday night at 8 p.m. Yeah. And yeah, we have an online account opening. I've talked about this already earlier just now. So you can open your account for futures and also CFD with ease and also convenience lah, because yeah, you don't have to purposely drop by our branch, but you can just do it online at the comfort of your home. All right, so if you do want to open an account, you can just scan the QR code and it will take you directly to the online application. So it only takes like 10 minutes to fill up your particulars and upload some documents for verification. And lastly, you would have to fund in a minimum of 1,000 ringgit to activate your account, but you can use this fund for trading afterwards. All right. So now onto our trading platform. Okay, the platform that we use for futures trading is called Phillip Nova. This is a web-based platform. It's very simple to use. So we also have a mobile app for iOS and also Android devices for those who like to trade on the go. Okay, our platform is equipped with a wide range of technical indicators, live charts, market depth function, and you can get access to both local and also foreign products. If you're not our client yet and you want to try out our platform and see the interface, right, we also have a demo account for you to try out. Okay, and then this is for stocks trading. The platform we use is called the Poems Global. So our platform offers advanced trading tools such as the technical analysis charts, stocks analytics, news and also analyst commentaries, and customizable alerts that provide users with an edge in making an informed investment decisions. So it's very suitable for new and also experienced investors. All right, lastly, we currently are running a few promotions. Okay, the first one is called the Trade and Earn with Phillip. So you can stand a chance to win exciting prizes, right, like iPad, iPods, Apple Watch, and also up to 1,800 ringgit of the touch and go relock pin, right, when you start trading any product with us. That includes either futures, stocks, or CFDs, all right. Of course, the more you trade, the chances of you getting the rewards, of course, are higher. Okay, so this promo will run till the end of this year. So it's a good time to start if you wish to get into investments. Okay, and then the second one is the Discover Singapore Stocks with Phillip Capital. So this one is solely for Singapore stocks. So if you invest in Singapore markets, right, you can participate in this promotion to get rewards for trading with us as well. So our rates for these Singapore stocks are very, very competitive. And for more information, right, you can scan the QR code to learn more as well, or you can get it our dealers, contact our dealers, and they will send you all the information. Okay, so before we dive into our topic tonight, let me introduce you to our speaker, Daniel Ang. He's from Singapore. So Daniel is the founder and CEO of the Traders Academy International. He is also a professional trader, speaker, and author. Daniel has a very extensive experience and knowledge in the futures market. He ranged from commodities, US equity indexes, and even Forex. So we are very honored to have him on board with us tonight. So do seize the opportunity to ask him any questions if you have, right, regarding the markets by dropping your questions in the comment box later, and we will address them at the Q&A session. Okay, so let us welcome Daniel. I will pass the screen to you.
Thank you very much, Abigail. Thank you for the great introduction, and a good evening to all of you for taking the time to attend this webinar. Today is a very special day because later on at 2 a.m. Singapore time or Malaysian time, the same. We're going to hear from the U.S. Federal Reserve regarding their latest interest rate decision, and the market has very high expectation, and we will talk a little bit about that as well. Okay, and without much ado, can I share my screen with you? If you can see my screen, can you just type yes into the chat box if there's one? Great, now let's get going. Now, of course, I have to also repeat the disclaimer that Abigail has gone through with you. Now, my version of the disclaimer says that the presentation that we are doing right now is not an offer to buy or sell any kind of securities, and definitely is not an offer for you to buy or sell any kind of margin products. And of course, we all understand margin products like futures options to carry risk. So do understand your own risk parameters and your suitability before attempting to trade any kind of margin products. And a good part of this presentation will be my views on the various markets, in particularly my views on interest rates, my views on treasury bonds, as well as equity index. So those are my views, and therefore they are definitely not the view of the sponsor as well as the host, and we will not be responsible for any action that you may take as a result of attending this presentation. Now let's get going. Now we all understand about 2 weeks ago, the world is still in a flux because we were talking about this big news, talking about the US debt ceiling negotiation. Now every so often, the US will have to negotiate on how to borrow more. Technically, the US Congress has actually placed a cap on US government ability to borrow. Now, this is a very old legislation going back to World War I, allowing the governments to actually borrow other than tax collection. We all know governments have incomes, and the income is not because they do business. The income is, of course, through taxation of corporation and individuals within the country itself. And then sometimes we know that the budget itself is overspent to the point whereby taxation alone is not able to cover the budget. So there is a need to borrow. And this is a very normal way of functioning as far as governments are concerned these days. However, the United States is very unique because every so often, like I mentioned, they have to raise that limit. And throughout the last, 60 years, the US government has actually have to negotiate to raise this debt ceiling or to temporarily suspend it over the course of 79 times as of this year. So 79 times for 60 years. Can you imagine every 9 months or so, the US government have to negotiate to raise the debt ceiling because without that approval from Congress, the US government cannot borrow. So this is the issue every so often. And like all the other years in which there is a negotiation on the debt ceiling, they have never failed to lift the ceiling, okay, or to at least temporarily suspend it, like what they did just 2 weeks ago. Okay, so this is now how they actually avoided a situation in which the US government cannot pay its bills. Okay, and the closest they ever come to not able to pay the bills was in 2011, whereby they actually has gone a few days past the deadline, what we call the X date, in which they have missed payments. Okay, so this is something that we will probably see again in the next 2 years after 2024, because the latest deal is that the US government can now borrow with no limits until the end of 2024. That is the current deal. Now, the deal content itself has a few salient points, one of which is that the favorite items for President Biden is to forgive student loan, and that is no longer allowed, and those students that have not been paying their loan because of this forgiveness, now that has been challenged in the Supreme Court, which may overrule President Biden's ability to enact this law to forgive. Okay, so that will come back to haunt those students over this student loan. And for those who are still on student loan, the current suspension will end in August of this year. So beginning August this year, student loan is back in the forefront, and that will be causing a lot of heartache for struggling Americans who are already having to deal with the high cost of living in the States. Okay, so this is currently where we are right now. They have a deal, it's suspended, it is not raised. Okay, it has been temporarily suspended conveniently past the 2024 presidential election, so that both parties do not have to contest this issue, whoever comes into take over the presidency after Biden's first term. Okay, so now what? The big question is, we have a deal, so what is going to happen next? In fact, every solution that they come up with always lay the seed for the next crisis. Now, we all know that the debt crisis has been resolved. Now, the US Treasury started to issue bonds, and this bond is essentially what we call the IOU, in which the US government borrow money from the public, and the US Treasury will issue a series of different securities from as little as 1 day to 1 month to 2 months to 3 months, all the way to 30 years bond. So they have a wide spectrum of duration of various securities that the US Treasury will actually issue to raise money. Okay, so we all know there's this thing called the Treasury General Account, the TGA. Now, this fact is that going into June the 1st, when they still do not have a clear understanding of whether they're going to get a deal or not, the US Treasury have left with only $23 billion. Now, this is very, very small change. It may sound a lot, but $23 billion for running a big, big economy like United States is probably almost scraping the bottom. Okay, so that was the fact. And immediately after the following day, after the debt deal has been sealed, the US Treasury started to issue bonds to the tune of $359 billion only on the first day. It means the following Monday, after the weekend in which this deal was announced and signed into law, the US Treasury actually managed to raise $359 billion. Now, that's a lot of money. Okay, and the target for the Treasury going into the third quarter of this year is actually to raise $600 billion, and before the end of the year they are looking to raise $1 trillion with 12 zeros. So you can see that the US is on a spending cycle which is totally out of control, and this will come back to haunt us again and again and again. Okay, so this is the background in which we are operating right now. Now, the implication of the Treasury trying to raise money in the large sum of money in such a short time of period, it's of course going to cause market dislocation. Now, Deutsche Bank, which is the largest European bank as far as counterparty is concerned, estimates that between June and August, the US Treasury will probably issue something like $800 billion worth of treasuries. Let me say, yeah, $800 billion worth of treasury that's going to flood the market. So what happened is that the market has existing issues of treasuries trading in the secondary market. Now, on top of that, we're going to have new issues of $800 billion coming online, and that is definitely going to affect the price of bonds, where we all know more supply means the bond price will have to come down, and that will obviously cause the yield on all these bonds to surge even further. Okay, now the Fed, do not forget, the Fed is currently still in a quantitative tightening cycle. Now, what is quantitative tightening? Now, you may not understand quantitative tightening, but you probably would have heard of quantitative easing, QE. QE is the flooding of liquidity into the financial markets by basically buying back all these treasuries from the banks and financial institutions in exchange for credit, okay, created by the Federal Reserve out of thin air. So this is the exact opposite, meaning to say that US Federal Reserve is trying to bring down their balance sheet from almost $9 trillion basically to soak up the liquidity. So when you have the Treasury together with the Federal Reserve, both are unloading treasuries, okay, that means to say that you have to ask yourself, who will be the buyer? Will there be enough buyer to absorb the mountains of treasury coming into the market? Now, JP Morgan, the other big financial investment bank, also predict that a combined liquidity crunch, meaning to say that it's going to be a situation in which liquidity is going to be sucked out of the financial system, and that will definitely negatively impact both the bond market as well as the US equity market. Now, we all know the equity market from the beginning of this year has been charging higher, especially tech stocks, and of course with the latest darling is ChatGPT and everything AI related. So we can see that the current rally has been led by tech stocks. Now, will this liquidity crunch that's coming online, would it cause the bull market that we are seeing currently to come to a screeching halt? That would be the biggest question that we all have to ask, whether you are a trader or whether you are a long-term investor. Okay, now the Wall Street Journal at the beginning of last week, or not last week, at the end of last week, actually came out with this, say that the $1 trillion worth of US treasuries coming into the market is going to cause a big of a hoo-ha here and actually spike volatility in the financial markets. So this is already been warned, okay, that we have so much supply of securities coming into the market, and that will definitely cause a lot of volatility across all markets, whether you're trading commodities or whether you're trading financials. So it doesn't really matter because all are interlinked. Okay. And then, now you probably have heard about US Treasuries. What are US Treasuries? US Treasuries, earlier on I did mention, they are basically papers issued by the US Treasury, which is essentially the finance ministry issuing IOU, meaning to say that, okay, the government need to borrow money, and in terms of the duration, there will be different durations starting from as little as 1 day to all the way to 30 years. So all these are categorized in different duration, and the price of these bonds is determined by market supplies and demand. Okay, right now we all know that there's going to be a deluge of new issues coming into the market. We already knew at the beginning of the year, in fact last year, when we have quantitative tightening, we have already seen bond prices been coming down. Okay, so now on top of this downtrend in which there's a supply of treasury coming into the market because the US Federal Reserve is trying to mop up liquidity. So what they do now is what we call a reverse repo, meaning to say that they are basically taking cash from the market and giving back the treasuries to the various financial institutions within the United States. Okay, so that is causing the bond prices to come down. We already saw what happened during the mini episode during the time when the UK Prime Minister Liz Truss actually tried to launch a mini budget that caused the British gilt, which is the equivalent of the US Treasury bond market, to actually seize up. Okay, so this is an issue that we probably will see going forward. It may not happen immediately, but I think it is something that will happen because the fundamentals are already happening. Okay, so when we see bond prices come down, the other thing is that we must not confuse the bond prices from the yield. Now, the yield is the coupon rate in which these different treasuries of different durations are based on. Obviously, if the demand is high, the coupon rate will have to go up. Okay, and if the demand is low, the coupon rate will go down, and this is called a yield. Now, earlier on I did mention bond prices and the yield are inversely correlated. If the bond prices comes down, the yield go up, and likewise, conversely speaking, if the bond prices goes up, the yield will come down. So what we can see here on this screen here, we have two different lines here, and we can see that the one in blue represents the yield and the one in orange represents the actual bond prices of a US 10 years Treasury note. Now, obviously, this is not up to date, but I just want to show you the relationship between the yield and the bond prices. They move opposite direction, okay? So don't be confused, because you can trade the bond market either by participating in the Treasury yield instruments or directly into the bond market itself, okay? So I did mention US Treasuries are issued in various denomination and in different duration, starting from 1 month, okay, 1 month to all the way to 1 year. You can see that this range of prices reflects the yield on these short-term Treasury bills. Now, the short-term is called Treasury bills, and the medium-term notes are considered as Treasury notes, and the longer term from 20 years to 30 years, those are considered to be Treasury bonds. So when people talk about Treasury bills, they means the shorter end of the of this Treasury curve. Okay, so you notice that the short end of this Treasuries issued by the US government, even in the secondary market, okay, is commanding a much better yield, okay, compared to, let's say, the medium term to the long term end of this curve, okay. And the reason here is very simple. People have no confidence in the long-term outlook of the United States economy, so they are not willing to buy. So you can see that the yield is not paying too high. Okay, so the demand are all concentrated on the short end of this Treasury curve, which is really unusual. We have seen this inverted yield curve, so to call. You have probably heard about this term called inverted yield curve, and this is always a prelude to a recession, and it has so far never failed to produce a recession whenever the yield is inverted, meaning to say people are willing to buy the short end compared to people buying the long end of the bond cycle. Okay, so this is exactly what we are saying, but it is not a timing instrument. It is just a sign that the demand for US Treasuries are concentrated on the shorter end of the curve compared to the longer end of the curve. So this is always a prelude to a recession. So this will have come. This will have implication. In fact, this has been ongoing for months now, but the US has not gone into a recession, not yet. Okay, so this is the inverted curve. Now we can see there is this example here of a 2 and a 10 years relationship. Now why I show you here, because you can choose to buy the 2 years compared to the 10 years, which is the medium term note. Okay, so there's always a spread. So we can see that the spread are actually crossed over from a normal curve. In the normal market itself, usually if you are going to buy the long end of the US Treasury, you want to be compensated with higher coupon rates. That is logical, because your risk stretch over a longer period of time. Let's say, for example, you bought the 10 years or even the 30 years bond. You know, for the risk of holding on to this instrument for such a long time, you want to be compensated by higher yields. Okay, but what we are seeing right now is exactly opposite. Nobody wants a long end, and everybody wants a shorter end. That means to say the market is inverted. So when you have this kind of inversion, whereby the yield for the medium term and the short term actually crisscross. You can see this at the beginning here on the right here. Sorry, on the left, you can see that the blue line is above the orange line, reflecting a normal market condition in which the longer end fetch higher yield compared to the lower end. But this changes, okay, at the in the middle of exactly 1 year ago, whereby the 2 years started to climb above the 10 years Treasuries, in the sense that, and it's still maintaining that spread difference. So we are seeing the inversion here in terms of that curves. So this is, again, many economists has been telling us this is a prelude to a recession. So when we talk about recession, what are the metrics in which we measure to see if the US economy will actually slip into a recession? First of all, you can see there are 8 charts here that I've actually shown you here. The one on the left is the US GDP, very easy to understand. This is the total productivity within the economy, how much goods and services they produce compared to what they import from overseas. So you can see as the number goes, in fact, the US economy has actually peaked in the 3rd quarter of 2022, okay? And since then, the market, you can see over the GDP based on a quarter-on-quarter basis, it has been coming down. So this gradient is suggesting that US economy is beginning to contract, although it has not gone into negative yet. The moment it goes to negative, two consecutive negative reading means the economy is technically in recession. Okay, so we are not there yet, but the curves and the gradient suggest that at some point, maybe in the third or fourth quarter of this year, the US economy runs the risk of actually dipping into a recession. So as far as the GDP is concerned, not yet. Okay, then of course we also use other metrics to actually measure the health of the US economy. The other one is of course measuring inflation, and we all know the Federal Reserve has been fighting inflation for more than 1.5 years now. Now at the middle of 2021, there were already signs that inflation is beginning to rear its ugly head. But we have been told then that inflation is transitory, meaning say don't worry about it, it's just a phase and it will be over. Okay, then what happened by March of last year, we can see the US Federal Reserve finally woke up and abandoned this transitory story and say that okay, now we have to fight inflation, because by then inflation was already raging. Okay, and it's no accident the timing in which the Federal Reserve starts to hike interest rate from near zero to the current 5.25% started in March. Now remember what happened in February of last year. That was the start of the war in Ukraine, and it's the war obviously makes the inflation situation a lot worse, and because we saw how energy prices has escalated. Of course, since it has come down, but that remains an issue. So long as the war in Ukraine is not settled, okay, we will continue to see inflation of this nature. Okay, and we can see the CPI numbers has come down very aggressively. Okay, the last number that we saw is actually this week. We saw, in fact, yesterday we saw the headline CPI numbers is down to 4.05%. So it does looks good, right? Because at the peak itself, this headline numbers was 9.1%. So that was a very scary number, right? But right now we are already at 4.05. Now, kudos to the Federal Reserve for actually bringing down domestic inflation, but elsewhere in the world we are still seeing elevated inflation. Don't have to ask anybody, ask your own household. Anybody within your household that's managing the family finance will understand that your money is not going far enough. Okay, so the Federal Reserve target inflation is at 2%, so we are 100% more than the target rate. Can the Federal Reserve bring down inflation to the target rate of 2%? Right now, it is almost impossible because things are still happening outside of America. Okay, so the other metrics that we do measure the health of the US economy is this thing called the Producer Price Index, which are input costs that US manufacturers actually have to contend with, whether it is energy products, whether it is raw material, labor costs, or all these input costs that goes into the production of a service or a product. And that one obviously has also been coming down, thanks largely to the prices of energy that has come down quite dramatically. But right now we are beginning to see that possibly there are signs that the oil prices may have actually hit the bottom and is getting ready to rally. Now, the other one, of course, we all understand is the non-farm payroll. It is the measuring of new job creation in the US, excluding the farm sector, because the farm sector has traditionally been very volatile. So they take over the farm sector and try to measure how many jobs are being created. You can see that the US job market is still very resilient. You can see that the latest number reading in the first week of this month, we see that the May number, they created 339,000 new jobs. Of course, these numbers are subject to revision and they can always move it downwards later on. So, but we can see that over the last 3 months, we can see that new jobs are being created, meaning to say the US labor market remains very resilient. Okay, on the unemployment rate front, we can see that this is a little bit of a head scratcher. While we have more jobs being created in the month of May, we have also seen an increase in unemployment. These two should not be showing the same trajectory. It should be showing something opposite. If more jobs are being created, unemployment rate should come down. But we are seeing a climb up in unemployment rate from 3.4% in April to 3.7%, which is quite dramatic, okay, on a month-to-month basis. But yet we still see new jobs being created. Not sure what is the answer here. Maybe the revision for the non-farm payroll will show a lesser job being created, or it could be most of the jobs are temporary in nature, meaning to say services sector, which is also understandable because we are going into summer, and usually summer the service sector tends to do well and they need to employ more people, and more people means this could be on temporary basis. Now, the other one is consumer confidence, and consumer is a big chunk in the US economy. After all, we all know that US economy is a consumerism economy. If US consumer don't spend, the GDP will shrink, okay? So that will again depends on how confident American feels about the immediate future, whether their paycheck is improving, is growing in line with inflation, or they see a decrease in disposable income. So the confidence index is showing us that over the last month or so, US consumers are less confident compared to at the beginning of the year. Okay, so the other one that we also measure is the durable goods. Now, durable goods refers to goods that actually are more durable in a sense, understandable, right? Things like refrigerator, things like a car, for example, those are more durable, and usually, and if US consumers commit to buying such durable goods, it means they have confidence about their future, their finances, and therefore they are committed. If you are not concerned about your income, then obviously then you can go out and buy. But let's say you have concern about whether you can keep your job, or whether the job that you are currently having is secure enough. If you don't feel so, then obviously you will hold back the purchases of, let's say, a TV set, because TV set, you can, unless it has totally broken down, maybe unless that happens, you don't want to buy a new one. So unless that translate into confidence, okay? Then of course, retail sales. Retail sales is a big chunk, okay? 70% of US economy is made up of retail sales, because earlier on I did mention, US economy is basically one of consumerism. US retail sales represents that, and we can see from the retail sales number, it is actually quite dire. The only time it actually went up was at the beginning of the year. Since then, the retail sales has been hovering at around the 0 point, and the latest reading is at negative 0.1%. So that is bad. Okay, so this means that if you translate all this into a picture, you can see that not all is doing well. Other than the job market being resilient, everything else does not look good. Okay, so this is the premises in which we are operating. Now, going forward, because of the very high interest rates from 0 to 5.25%, we can see the retail mortgage rate has also gone up to 7-8%. So we can see that also include the credit cards interest rates that Americans have to pay. Of course, that also include the car loans, include the mortgage rates. So everything is costing more, okay? And beginning to see Americans missing on paying their bills, and this is called delinquency, and this is at a 13-year high. This is a number that was published not too long ago, and we can see that as far as we can see, those first Q1 numbers is already quite scary, because we are beginning to see it affect across the entire spectrum of the US economy, from the housing to the auto loans to the credit cards. So you can see that American consumers are now having difficulties securing credit at a good price. And on top of that, we have the bank failures. Remember, about 2 months back, we heard a lot about bank failures, and because of the bank failures, one after another, banking standards has actually been raised, meaning to say that banks are very, very stringent in offering loans, whether it is for existing loans or to roll over existing loans. So these loans are beginning hard to come by, and this is what I call a restriction in lending standards, meaning to say that US consumer will find increasingly difficult to secure a loan. And that also applies to companies. For example, the auto loan market, okay? When cars are not being sold, they remains in the show house, okay? In the show house, and this inventory costs money. So sometimes they have to go to the bank to get a rolling loan to make sure that they can continue to service these cars until they leave the showroom, the showroom, until people buy. So right now we are seeing that there is that slowdown in auto purchases among Americans. Of course, the demand for auto loans has gone down, and of course, cars are not selling as fast as they were, and this all builds up inventory, is causing a headache for car dealers. So all this is across the board, not only the consumers, the companies, their services, Americans are also feeling the pain. Now, what you can do, knowing this as a fact, is that treasuries are coming into the market to the tune of hundreds of billions of dollars worth of treasuries coming into the market. That means there is an oversupply. When there's oversupply, what happened to the price? The price will go down, meaning the bond price will come down. Now you can take advantage of this phenomenon that we are seeing right now and into the next few months until the end of the year, because don't forget the treasuries is going to issue $1 trillion worth of treasuries of different duration to flood the market. That means there'll be more supply coming on stream, and that means prices of bonds will have to go down. You can take advantage of this by participating in this thing called the US Treasury note futures. Now, Treasury notes futures are basically medium term. Of course, you can trade the lower end. Over here, there is two tables here. On the left, you have 10 years Treasury, which are medium term. If you have a medium term outlook on the US Treasury, you can trade these products here. And the contract specifications are as follows. They are worth $100,000 of face value. And there's a product code called ZN. And the way they price it is quite a bit of a mental somersault, because the Americans still use the imperial system. Okay, so they still use fraction. So this fraction here, 1/2 or 1/32 is equal to $15.625. Okay, and they are quoted in every odd months in terms of the quarter itself. We have March, June, September, December, and then roll on for another 3 more rounds. Okay, and the timing here, I've changed it for your convenience to Malaysian timing. Market opens at 6 a.m. Malaysian times, and it will not close until Saturday morning Malaysian time. Of course, at 6 a.m. you will only be trading the electronic version of the underlying products, and of course until the US market opens like right now. Okay, and this is a deliverable product. So that means that if you hold on to a short position, you are expected to deliver, and if you're holding to a long position, you will expect to take delivery of the underlying 10 years Treasury note. Okay, the margin right now is $22,250 US dollars for now for maintaining a position overnight. But however, if you trade intraday and close out your position within the day itself before the market closes, that margin is only $400. So of course, these margins are not cast in stone, depends on the volatility. The higher the volatility, the higher the margin. Now, of course, the exchange reserves the right to change this requirement on short notice. So make sure you don't trade full margin and leave always a little bit of a buffer in case the margin changes to the upside. Okay, now if you also want to participate in the shorter end of the Treasury bills, now you can also do that. This is a 2 years Treasury note, and of course this one has double the face value of the 10 years is 200,000. The code here is ZT. Okay, and again, the way they calculate is based on fraction. 1/8 of a 1/32 is equal to $7.80 thereabout. Okay, same thing. It is quoted every quarterly for March, June, September, December for the next 3 quarters, and the timing is the same as the 10 years note. And this one is also deliverable in the sense that you have to make sure that you don't trade until the very last trading day. You want to exit before the last trading day, and make sure that you don't have to contend with delivery. Okay, here the margin is a bit lower, $1,400 for overnight trades for maintenance, and on an intraday basis, provided you don't hold a position overnight, is $245. Now, when you look at the bottom here, these are graphs that reflects the interest and the volume traded, and you can see that the volume is in the millions. On yesterday, the volume traded is almost 2 million contract. 2 million contract is a lot of volume, so the market here is very, very liquid. And you can see that the open interest is 4.6 million contract, meaning to say people trade the Treasury, they hold on to the position. These are not, the bulk of the trades here are not for day trading, these are for term trading. Okay, so you can see that when the open interest is above the volume, these are a reflection of people's trading pattern here. It means that people who participate in these treasuries, both the 2 and the 10 years, you can see that the open interest is a lot higher than the daily volume. Over in the 2-year note, we have 760,000 contract traded. Not as good as the 10 years, but it is still very liquid, by the way. And you can see that for those holding the position overnight, open interest means they are not liquidated. The position yet is 3.3 million contract. So most people are doing this for term trade. Okay, so this is the chart of a 10 years Treasury note. September contract right now is the most active contract, and we can see this is a weekly time frame. A weighted time frame means you zoom out of the market to get a better perspective of the entire market. Now this market here reflects the price of the bond itself. So this is the bond price of a 10-year Treasury note here, and it has been coming down since 2020. What happened in 2020? Do you remember? We have the pandemic, right? So we have the situation in which the Federal Reserve now is thinking of trying to lower down their balance sheet. You can see that the price has been coming down and it remains in the downtrend. So the directional bias in the US Treasury as far as the 10 years is concerned, it is a downtrend. So the rebound from the low here at 108.26, okay, is basically a technical rebound. And this rebound here has not reached my ideal target, which is 117.26, okay. So if the market goes up into this bracket of prices, to me that offers a chance to look for selling opportunity in the weekly time frame. The reason why I even look at a weekly time frame is to get a perspective of the overall market. Now, most of traders here typically will zoom in on the intraday price pattern, and that can be actually quite detrimental to your health, your financial health, I mean here, okay, because when you are too concerned about the intraday movements, you lose track of the larger picture, okay. So it's quite useful to periodically zoom out of the market to take a look at the higher time frame so that you can get a better perspective of where the general market is heading. If the market is down, obviously you are looking for selling opportunity. So right now, can you buy or can you sell? That is the question. So every time you are in the market, whether it is today, whether it is tomorrow, you will always decide today whether should I be buying or should I be selling. That decision must be based on an idea. The idea is that you must have an overall picture, okay. So when I zoom in on the daily, which is what we are seeing here, this is the daily time frame, again reflecting the September contract. You can see that this rebound here from 108.26 is probably incomplete, okay. If we get a chance for the market to rally up to 117.26, that offers a selling opportunity. The thing is that, can I sell once the market hit 117.26? Again, I would love to see a reversal pattern. What are reversal patterns? If you go back to candlestick analysis, very simple. You can have one candle bar reversal, you can have two candle bars reversal, you can have three candle bars reversal. So it all falls back to your basic skill to analyze the reversal pattern. So if you get one, then obviously it is likely to move in your favor if you go short when you see a reversal pattern in a bracket of prices that's vulnerable to selling interest. Okay, why I'm saying this, market has a pattern of doing a three-wave corrective pattern. Now, the corrective pattern can be a down pattern, can be an up pattern. In this case, we have a existing downtrend. The market is rebounding in a three-wave pattern, and this three-wave pattern usually ends at a relationship of 1:1, meaning to say the first leg of the rebound is probably equal to the second leg of the next rebound. Okay, so what I call the ABC move. Okay, ABC move is equal to AB equal to CD, and if that's the case, the equality price is 117.26. So it may come, it may not come. Sometimes you overshoot. So the whole idea is that do not just go into a trade position just because you see the price goes into a bracket of prices which you deem to be quite favorable to trade counter trend. So always look for confirmation. Confirmation can come in the sense of a reversal pattern in the candlesticks in the lower time frame. Okay, so this is a daily time frame. So of course you take this concept and you go down to the lower time frame and you have a system in which you can actually trade. Okay, so when you look at the 2 years, this is the same market. You can see that 2 years, very similar to the 10 years Treasury note, is on a downtrend. Okay, this is the overall trend that we see in the 2-year note, and it is also telling us that the market is coming down. So you want to be looking for sell signal rather than buy signal, but that doesn't mean that you cannot buy. Sometimes it is advantageous to buy, especially the market move into extreme. In this case, the market has has bottomed out at 101.09, bounced back to 104.11. Looks like it will probably, if the idea of a three-way rebound is correct, then obviously we want to see another leg to the upside, ideally to 104.28. Okay, that will be assuming that the low for this current decline is 101.26. We do not know for sure whether 101.26 is the exact low here, but it is low enough because when you look at risk reward comparison, you want to make sure that you don't take excessive risk. So there will be time whereby whatever your analysis is, there can be a period in which you can be wrong. Then the reason is of no value. But the main thing is that when you look at price, it is right now very actually advantageous to be trading the counter trend. The dominant trend is down, so this rebound here to 104.11 is actually part of a counter trend, and usually this counter trend unfolds in a three-wave pattern. Okay, so currently the low here is 101.26, and the up of as of this afternoon, the market is at 102.08. So that means the market is within this price range, which actually, in my opinion, so long as the price remains at 101.28 to 102.11, this price range is actually quite conducive to buy. And whether I can buy now, I have to refer to the lower time frame, such as the 1 hour or even the 15 minutes, to take at the lower time frame chart to look for a very distinctive reversal pattern so that I can go in and buy. And my target immediately will go to 104.28. If I'm wrong, I will exit my trade if the market goes below 101.09. So it's on a risk reward basis. I have very little risk so long as I buy within a 101.28 to 102.11. And if I'm wrong, I will cut loss at 101.08 or lower. But if I'm right, my profit taking target is 104.28. That is a measurement of whether how you evaluate a situation, whether it is worth your while to take a counter trend trade. Okay. Now, when we look at the market itself, this is the daily time frame, very similar to the 10 years. We have the weekly, we have the daily. So right now we go in to see the lower time frame. Prices is now currently at 102.08, which is ideally in a bracket where I think it is more advantageous to be buying rather than selling. Like I said, if I'm wrong, I will cut loss at below 101.09, and if I'm right, I want to take profit at 104.28. So this actually gives us a very superior risk reward ratio here. So this is an example of how you should analyze your whether you should be participating in this product or not. Okay. Now the other way you can participate in a US Treasury bond market is trade the yield. Remember, the bond price and the yield are two opposite direction. They are two faces of the same coin. Okay, both are bonds. One's talking about the yield, one's talking about the price of the bond. So you can also trade the yield instead. So when you pick the product, make sure you're not confused what you are trading. Okay, so again, this product specification here say the 10-year note yield future. This is the yield, I mean the coupon rate. Okay, it's very different. The pricing is also very different. Now, based on 1,000 points, and the symbol is 10Y. And the way the minimum tick movement is 0.0001 of a 1/10 of a basis point equal to $1. This is a very, very small contract because this is a micro contract. Okay, and the timing of trade is the same as the underlying bonds. And we can see that this one is very different from the Treasury notes itself. This one actually is financially settled. Meaning, say if you're holding a long position onto the very last day, whatever the difference between the last settlement price and your open position, you can settle by cash. Okay, meaning a debit credit of your trading account. So there's no need to deliver, so don't have to worry about that. And the margin is considerably lower for overnight trade. The maintenance margin for a micro 10 years note yield futures is $390, and for intraday is $85. So it's actually very affordable. Now the other one is that it's a micro 2 years note yield. Okay, we are talking the 10 and the 2. Okay, very similar. And here we have the contract size is very the same, 1,000 index point. The symbol here is 2YY, and the way they calculate is the same, 0.001 equal to $1, and everything else remains the same except for the maintenance. Maintenance here is marginally higher at $420 for overnight trade, and intraday is the same at $85. Now, when you want to see whether you should be trading the underlying bonds or trading the yield, take a look for Qs, okay, in the open interest and the volume. You'll notice that the volume is less than 3,000 lots traded overnight compared to the 1.9 million contract traded in the underlying bond. So you can see the internal volume, the yield product here is of less player. So when you see a volume that is not as great as the underlying, that gives you a clue as to whether you should be trading the yield products or you should be trading the underlying bond product. For me, it is a no-brainer. I want to trade a very liquid market. Now, why would I want to trade a very liquid market? Because it brings down my overall risk exposure. In a sense that the spread between the bid and offer will usually be very competitive. In a market that is less liquid, it tends to have this phenomena in which the bid offers are relatively wide. So that increase my risk, increase my cost of trading. So always take that into consideration. The open interest here remains the same above the volume profile here, 5,860 as of last night. That means these are positions that are left open up to now. Okay, and in the 2 years Treasury yield futures, the volume is even lower, less than 200 lots traded overnight okay, and the open interest is only 732. So you have to make your own decision. For me, I would rather trade the underlying bonds compared to the yield because of simply the liquidity is not as competitive. Okay, so there you have it. Now, when you want to consider trading the yield, let's consider the 10 years yield, which is the more liquid of the two. Okay, if you have to trade the 2 years yield and the 10 years yield, then obviously 10 years yields offer a better product here in terms of liquidity. Now, remember, the bond prices is moving opposite the yield. Okay, so while we see the bond prices coming down, if the dominant trend is down, the yield should be reflecting the exact opposite. Okay, the yield has been climbing since 2020, and it is an uptrend. So you should see a mirror image. Whatever you do in the bond market, you are doing the reverse in the yield market. So here we are beginning to see also similar pattern, a three-wave pullback, potential three-wave pullback, and this pullback does not look complete. It may go down to at least 3.075%. Now here it is quoted in percentage term. Okay, so in terms of the long-term perspective of the yield, there is a possibility the 10 years yield may actually go up to 5.459. Okay, this is the long-term projected target for me for the weekly time frame. It means to say that as far as I'm concerned, I do see bond prices continue to fall, and I see bond yields continue to climb. So this is going to be key because again tonight we are into that crossroad in which the Federal Reserve will have to decide whether it's going to pause or is it going to continue to hike, because whatever they decide will also decide the bond prices as well as the yield. Okay, so based on this chart here, I will be more willing to sell if the market goes up to almost 4%, and if market do come back to 3.07, I'll be more of a buyer than seller. So obviously the trend is up, I want to be buying with the trend, but if sometimes it does pay to trade counter trend. So if the price goes up to 4% to 4.1%, I will be more willing to sell, because if I'm wrong, I will have to cut loss. I will cut loss at 4.34 and above. Okay, but if I'm right, then I will take profit at 3.07 thereabout. So the risk reward always must be at least 1:2, ideally 1:3, if not more. Okay. In the lower time frame, this is the daily time frame of the same 10 years yield futures. You can see that the pullback that I'm talking about is actually very evident here. Prices overnight seems to be stable, and there's a risk that the market may actually go up to the 4% range, anywhere between 3.979 to 4.136% is actually more suitable to selling than buying. So I will have to look for confirmation in terms of the reversal signal in the candlestick. Now, if the price goes down, I want to take profit at 3.07 thereabout. So this is how you will analyze this market going forward. Now, let's talk a bit about equity index. Obviously, tonight the market is going to move regardless of what the market, what the Federal Reserve decides. The market has already priced in the very likelihood that the Federal Reserve will pause. Now, remember the language the Federal Reserve have been using of late is not pause. Now, a few months ago, the market is talking about a pivot. So what is a pivot? What is a pause? A pivot means the US Federal Reserve reversed its monetary policy from tightening to easing, meaning to say they will start to cut rates. It will not happen, at least not now, until we see signs that US economy has slipped into a severe recession. That means a hard landing will probably cause the Federal Reserve to consider cutting interest rates. For the time being, the message that we've been getting from all the various governors of the Federal Reserve have been telling us that it's going to stay higher for longer. So the pause, if we get tonight, is just an intermediate pause. Now they call it a skip. So a skip, why they use the language a skip instead of calling a pause, because they both is referring to the same thing, a temporary stop in the rate tightening cycle. Okay, the reason I believe is the Federal Reserve is trying to convey a message because we already seen market participants take a pause as the signal to buy. To buy what? To buy equities. Okay, so the Federal Reserve does not want to see bubbles building up in equity markets, so they have been telling us it's going to be a skip. So you must read in between the line. So if we see bubbles building up as a result of a pause tonight, prices are likely to go higher tonight because it's already built into the DNA. When people see lower interest rate or a pause in interest rate tightening, they see it as a signal to buy. Now, don't forget the US equity market has been rising consistently since the beginning of this year, especially the tech stocks. when you see the Nasdaq 100, it has been going higher and higher and higher. So we are already at a record high as of last night. Today, of course, the market has already opened. I have not seen the price, but I won't be surprised the market will be hanging on until 2 a.m. tonight. Okay, so watch out for a reaction. The market is already pricing to go higher. So if the market goes higher, now there lies the proverb called buy the rumors, sell the fact. The market already expected the Federal Reserve to pause, and if the pause become a reality, those people who have already long will take the opportunity to actually take profit. So do not be surprised if we see a reversal after the announcement is made after 2 a.m. or maybe even towards the end of the week itself. So this is where we are at right now, a junction. So when we look at the open interest for trading the equity markets, the most popular one is by far the S&P 500. I started trading the S&P 500 back in the late 80s, okay, late 80s, early 90s. Okay, I've been trading the S&P 500. In those days, there's no E-mini, there's no micro E-mini, so we were trading those regular, right now considered to be a huge contract size product. But in those days, the index is actually at very low level. Obviously, the market have already more than quadrupled over the last 20, 30 years. Prices cannot be where it is. Okay, so we can see that the open interest, let's go to the contract spec. This one is a micro E-mini contract. It means to say that this is actually a product that's launched to cater to the retail investors. The reason why they have to do that, because the margin requirement is based on the percentage of the notional value. So the price of the index has gone up so many folds, it's no longer affordable even if they only collect a fraction of the margin required. So they will have to design a smaller contracts to actually cater to people like you and me. So this contract here called a micro E-mini S&P 500 futures contract is worth $5 times the index value, and the symbol is MES. The minimum contract movement is 0.25 points, equal to $1.25. So this is actually a very accessible product because the movement here is not so big. Okay, so the listed contract is every quarter, March, June, September, December, for the next 5 cycles. Okay, trading hours the same as the bond market. We have 5 o'clock in the morning. Sorry, this one is slightly earlier. 5 o'clock in the morning during the electronic trading to 6 a.m. Our time on Saturday. Okay, and this one is financially settled, meaning that you don't have to worry about delivery. And the margin maintenance here is $1,120 for overnight trade and $37 for intraday. Now you can see that the volume traded is humongous. We are talking about a daily trading volume as of last night was almost 500,000 contracts. Now don't forget, this is a micro product. We are not talking about the regular S&P 500 or even the E-mini. This is a micro contract. It has 500,000 contract being traded just last night. It's already evident that this market has this product is very successful. Okay, then the overnight, you can see the open interest is at the highest so far in from May last month. Okay, it's 1.26 million open interest, meaning that you can see here you can see that the open interest here is the volume is higher than the open interest. I beg your pardon. Okay, the volume traded is 1.26 traded overnight, and the open interest is 500,000. So this is exactly opposite from what we saw in the bond open interest and volume. Here it shows that most of the trade, okay, are for day trading. Because the open interest is lower than the volume, it means that people are doing a lot of day trading. So it's a very popular product for people to scalp the market, okay, because it's very affordable. Okay, so now we look at the chart itself. We can see that the market here is telling us the low that we saw here is in the start of the pandemic. Okay, very much where the bond prices peak, prices comes down, and we also saw the bond market, the equity market actually bottoms down in the S&P 500 at 2,191.66. This are referring to the cash index. Why am I looking at the cash index? Because we need to take the cash index for referencing. Okay, again, this is the weekly time frame. The market is in the bull market, 4,818, which is actually the peak at the beginning of last year. Now, last year, within the first 3 days of the new year itself in 2022, the market actually peaks, okay, and it has been coming down throughout the whole of 2022. Now this fortune changed towards the last quarter of 2022, and the market actually stabilized and bottomed out at 3,491, and the current price is at a year high at 4,375. Now, a lot of analysts has said that, okay, because if you measure the low here at 3,491 to the high of 4,375, the market has moved higher by 20%, and they classified this as the new bull market. Is it so? Not yet. As far as the daily weekly time frame is concerned, we are still in the bear market as far as the weekly time frame is concerned, and that will only change if the market breach 4,637.3. Are we going to be anywhere near there? Maybe it will go there, maybe it will not. But immediately now, I can see that from the weekly time frame is beginning to get very interesting if I want to short this market, and I have a price range in which to do that. The key level here for me is 4,506 to 4,512. Okay, then again, this is the cash index. I will have to refer to the lower time frame in the futures market equivalent to take a better look. Okay, so right now the market has unfolded in a three-wave rally. Can you see the three-wave? This three-wave again is happening across all time frame. This is seen as a technical rebound. So the dominant trend is down, at least in the weekly time frame, and the rebound from 3,491 is seen to be a technical rebound, and we are fast approaching the equality level, which is at 4,512. Okay. In the weekly, in the futures contract, this of course refers to the micro E-mini S&P 500. Okay, you can see the symbol here, EMS September 2023. Okay, so you can see that in the lower time frame, this was also unfolding in a three-wave, targeting at least for now 4,465 to 4,542.5. We are very, very close to this target here. Maybe tonight we can see this price, and I want to see the reaction once the market trade into this bracket of prices. If I get a reversal by tonight, okay, I know for sure that the market may actually pick, and I want to trade to the downside, because this here is represented by a larger pink color box, which is telling me it is advantageous to trade to the downside rather than to the upside. Okay, so be careful about chasing this market ever higher. Wait for the market to reverse, because I think we are very, very close to at least a pullback. Okay. Now, when you look at the other equity index, the next most popular index in the US equity markets offered by CME is this thing called the Micro E-mini Nasdaq 100. Now, Nasdaq 100 is a sub-index of the Nasdaq Composite Index. Well, we all know this Nasdaq composed of largely tech stocks, and is also very, very popular, especially this year. Last year, nobody wants to own tech stock, but this year is the flavor of the month. Everybody want to get involved in tech stocks, especially with all this AI and chat GPT that has constantly been in the news. The market is buying up anything that is tech related. So if you want to trade this product here, you know that the contract size is $2 times the index, and the code here is NQ. The minimum price movement is a quarter point, equal to 50 cents. And this one trade in similar March, June, September, December cycles. Okay, and the timing is the same as the Micro E-mini S&P 500. Again, this one is financially settled. There's no worry for settlement. And then the margin required is 1,680 for overnight and $85 for intraday. The volume traded is also very respectable. You can see more than 1 million contract traded overnight, and the open interest is only 1/10 of the actual volume. Meaning to say 90% of the trades that goes into the Nasdaq 100 is actually intraday, leaving only 10% that they keep as open interest. Okay. So this is the weekly time frame in the cash index. Again, taking reference on the cash index, you can see that the market actually bottoms out in September or March of September 2022. Sorry, not September, it's March of 2022, where the market actually have a big fall and then stabilize before the market goes higher. So this market went into a new high from 6,772 all the way to 16,764, which is a huge move considering the market just has experienced a very short, sharp fall from the February high. So the market now is again looking at this weekly time frame is in a down market. The dominant trend is down, but we are fast approaching a situation in which this level here, 15,265, may be taken up. If and when it price do breach this level, the entire structure here will turn into a bullish outlook rather than a bearish outlook. Until that happens, I am more interested to look for selling opportunity, but looking at the price right now, it does seems to be very, very bullish. So for time being, just monitor, do not go short just because the market is nearing to 15,265. Okay, so my target here is for a move to just under the 15,265, somewhere around 15,189. Okay, Don't ask me how I get this target, because that will be involving a different thing altogether. If you are interested to know more, reach out to me. Okay. So in the daily time frame, in the daily micro E-mini Nasdaq 100 futures, we can see the price is getting very, very close to this crucial point here. Translated into the futures market, this level in which it will be pivotal to me will 15,269. If the market ever breached this level of 15,269, which is like almost right, just could be happening tonight. Okay, if the market do that, then the entire structure will turn from bearish to bullish, at least in the daily time frame. Okay, right now the market is trading within a very, very neat channel, and if the price break the channel, it's going to cause more buyers to pile into the market. However, there is also the risk that the market may actually flip from here. So from a risk reward position, all that's missing right now is for me to see a sell signal, either tonight or tomorrow or before the end of the week. If I do see one, so long as it's below 15,269, I am more than happy to sell, because my risk is so small. If I'm wrong, I will cut loss at 15,270. If I'm right, everything below here, south of this move, is all my potential target. Okay, so this is where we are right now. Now, the other one that you can also trade is the Dow futures. Now, the Dow futures has actually very, very little volume compared to the Nasdaq 100 and the S&P 500. You can see the contract spec is 50 cents times the index. The symbol is MYM, index point minimum move 0.1 equal to 50 cents. Again, very similar. March, June, September, December cycle, financially settled. We need to say you don't have to worry about delivery. The margin is actually very affordable. $800 per lot for overnight, $70 for intraday. But you can see that the volume traded is less than what, 100,000. Very decent, but not as good as the Nasdaq 100 or even the S&P 500. So you can see that the volume traded is not as good. So you can make a decision whether you want to trade the Dow. And of course, the open interest is a lot lesser than the daily traded volume. About 60-70% end up as intraday trading. Okay, now when you monitor the Dow, do understand the Dow is the bluest of blue chips. So fund managers love to trade the Dow because it represents part of their portfolio. If they are very big fund managers, they want to have exposure in those component stocks in the Dow. So it is no wonder the retail is not very the retail investors are not too much into this Dow index here, more for the hedge fund managers. Okay, and the hedge fund managers definitely will not be trading the micro E-mini. They'll be trading the regular contract, if not the E-mini. Okay, so this is the overall outlook. Again, I'm referring to you the cash markets. The Dow Jones actually bottomed out at 18,213, had hit a high at 36,952 at the beginning of 2022, and it has gone into a counter trend pullback, and that pullback ends towards this November of last year at 28,660, and we're beginning to see the bounce here. So far this year, the Dow Jones has been lagging behind the S&P 500 and more so also against the Nasdaq 100. So the Dow here is a laggard. Most of the activity in the buying side reflecting the tech stock that are basically the FANG stocks, the top 5. In fact, when you look at the S&P 500, the rally has only led by 5 component stocks. The main one are the FANG stocks that led the S&P higher. Okay, so here we can see that the Dow Jones is not necessarily trading very robustly to the upside, but again, we have to see this market is doing a corrective rebound, and if this rebound end up as a 3-wave equality move, then the target may be seeing 37,481. But in the event the market cannot cross above 35,824.3, then the market has a tendency to want to come off. So watch out for downside, because if there's going to be a down move, it will probably happen in the Dow first, rather than the S&P 500 or the Nasdaq. Always buy the strongest, sell the weakest, because here you have a choice. Okay, so this is the overall view for the daily time frame on a micro E-mini Dow. You can see that the market has a potential target right now for this internal 3-wave rally. I'm looking at 35,342 to 35,000, even 36,000 thereabout. So long as the price will not breach this level of 35,754, I am looking to sell. Okay, but right now I can't sell because I need confirmation in terms of a selling signal. Okay, now this other market here is very interesting. Very few people trade or even understand there's an index called the Russell 2000. This refers to the small cap, make up of 2,000 smaller, lesser known stocks. Okay, and the index here may be very interesting because we're talking about a banking crisis. And if we see the resurgence of a banking crisis, this is one market you want to go in and sell, because a lot of regional banks are inside the component stock of this index makeup. Okay, so if we see another banking crisis, more bank failures, we probably will want to sell this index because it will impact this index negatively. Here the index here is $5 times the index. The symbol is M2K. 0.1 point move is equal to 50 cents. Again, very similar to the other index futures. We have March, June, September, December, financially settled like the rest, and the margin here is very, very affordable. $620 for overnight trade and only $30 for intraday. So if you got a view on the short term of the mom and pop shop, then this is an index for you to trade. Okay, do not believe that this is not a viable product, because it's quite viable. Okay, the daily volume as of last night is again less than 100,000 lots being traded. The open interest is less than 28,000, but it's still relatively liquid, so you can actually take a view and trade this product here. Now, this is the cash index reference. Everything is the same as the rest of the other index here. You can see the market bottom at 966, rallied all the way to 2,458 before it pulls back. Now you can see that this market here is not as bullish as the Nasdaq 100 or even the S&P 500. It's not even as bullish as the Dow Jones. So you can see that if the market ever turned down, the first index I would sell will be this index here, especially if we see news that their banking crisis is back with a vengeance, which I believe it will, because now there are news that there are at least 700 US banks that are in near insolvent. So if higher interest rate cause the regional banks to fail, this will be one index I want to be involved in on the short side of the market. So if this market somehow managed to do a 3-wave rally, my target to sell will be somewhere in the 2,030 to 2,122 in the cash index. Now, this is of course referring to the weekly time frame. When I go down to the daily time frame using the micro E-mini Russell 2000, you can see that it also reflects the same situation. Right now the market is in the middle of nowhere. I can't buy, I can't sell, so I'm just waiting for market to give me a direction. If the market ever get higher to 2036, and then I want to look for sell signal. As simple as that. So sometimes it's worth a while to stand aside, sometimes you want to get involved. So it's not every day that you want to be trading the same product in and out, day in, day out. So we are right now overshorting. Okay, I may not be able to cover everything that I want to cover, because there's a lot more to this than just playing the interest rates, because we know tonight is going to be the night in which interest rate is going to move the market, and it will move all markets, whether you're trading precious metals, whether you're trading commodities like crude oil. So they will all move simultaneously. Okay, but because of time constraint, I have not been able to continue more. But if you want to know more, just know that you can come to my webinar every Sunday at 8 p.m. This is a free to attend webinar. I don't sell you anything. I don't intend to sell you anything. So if you are interested to know about my view of the markets, do come and listen to this webinar. There is a QR code here. Take a screenshot of this, or even to scan the QR code. If not, then check for the login at my on my Facebook page. So this is where you can. Now we have come to the stage where I'm open to questions. So if you've got questions, please send them in. Abigail, you want to help me to get the ball rolling?
Yes, okay. Thanks, Daniel, for your insightful sharing on the US economy and also the possible scenarios from the technical analysis. So now we will go on with the Q&A session. So the audience can just drop any questions you have inside, and we will answer them. Okay, so I have one question here from Sam. Okay, he's asking, like, what is the meaning of the cash index? Can you maybe briefly describe this? Yeah.
If you read any financial papers or magazines, whether you turn on the CNN or we turn on to, let's say, Channel News Asia, for example, the newscaster will be talking about the index. Those numbers that they mention, whether it's the Dow Jones, the S&P 500, those refers to the cash index, which is actually the index that measures the average price movement contained within the component stocks. These are the one that you cannot trade. You cannot buy, you cannot sell. It's just a measurement of the makeup of the components of stocks that make up the index. In the Dow Jones, there are 30 stocks. In the S&P 500, there are 500 stocks. So an average of them calculated in real time is reported every day. So we get a sense of the general movement of the market itself.
Okay, yeah, I guess that does answer the question. And then, okay, I do have a question, in case, some of the audience also might have this question as well. So you said, right, we could likely see a pullback since the US index have rallied a lot. So if investors want to short the US indexes, right, which of the 4 indexes do you think has a better opportunity?
Based on risk reward, right now, the one that has actually overshoot is obviously the Nasdaq 100 and S&P 500. These 2 index has actually gone way ahead of the other 2 index in terms of Dow and the Russell 2000. So if there's going to be a pullback, it's very likely to see the signal in the Nasdaq and or the S&P 500. But purely because the market right now is very near to the crucial point which I listed earlier on, I have very crucial level in which I'm looking at. If these crucial levels are not breached, then it is definitely ideal to be selling. But again, I have to watch out where the market is. And of course, I want to see a reversal signal in the lower time frame. The lower time frame can be 1 hour, can be 15 minutes. It all depends on your personality, whether you are trading intraday, whether you're trading for swing trades. Okay, I'm more of a swing trade, so I'm not too concerned about the intraday move, okay? And that could be your style of trading. So it really cannot say which is the better index to trade. But given if all else being equal, I would prefer to sell the Russell 2000 because it is the weakest of the 4, and followed by the Dow Jones, then S&P 500. The one that is the strongest right now is the Nasdaq 100. So the question we have to ask ourselves every single day is, can I still buy the Nasdaq 100 or even buy the S&P 500? You may have to make a decision at some crucial point in time, and the point has not reached yet, in my opinion. Right now, it is ideal to sell these 2 index that has been leading the charge higher, which is essentially the Nasdaq 100 and the S&P 500, provided I get to see a reversal signal soon, because the crucial level is about to be breached. Okay, if the market did not breach those levels, and you have to confirm that when you see a breach of crucial levels in the futures market, because futures market are more reactive, they tend to move a lot faster. Okay, so when you see a breach in the futures contract, just before you do a counter trend trade, just refer to the cash index. Has the same thing happen in the cash index? You do not want to be selling the futures when the cash index has not shown us that it has a reversal pattern. Okay, so make sure that they are synchronized. Ideally, you see the same thing either in the cash index together with the futures contract, then you do a decision to trade counter trend. And always make sure you put your stop in place, and the risk reward ratio must make sense. Okay, a 1:1 trade I will never do. 1:2 trade I may not even do. I will only consider a trade if the risk reward is at least 1:3, meaning say I risk $1, I want to have the potential to make at least $3, if not more. Okay.
Oh, okay. I think, yeah, guys, you can take note, right? If you're looking at the technical analysis, so do pay attention on NASDAQ and also S&P for any opportunities. Okay, next we have a question from Nicholas. I think he's asking more on the technical aspects, right? He asking if Daniel, you have any technical tools that you use to project sell and buy zones, or maybe do you have this in your usual session on or the FPM session? Yeah,
I do. Okay, a lot of people trade using technical analysis and indicators. I used to do that until it tells me that maybe that is not the best way forward. I'm not saying that technical indicators do not work, just that they don't work for me. So I have decided to trade based on fractals. Now, fractals are patterns that we are seeing all around us. We are also seeing fractals in financial markets, and they are all quite universal, and they repeat the same pattern in the lower time frame as well as the highest time frame. I see the same pattern again and again and again. So I use a lot of fractals. I use a lot of Fibonacci extension. I do a lot of Fibonacci retracements, and those levels are my key guiding area. The one thing that I always do is to make sure I find a directional bias. If the market wants to go up, I want to ideally be trading with the trend, but there are times when I also trade counter trend, especially when the risk reward makes a lot of sense. So again, I first decide which way the market is heading. Is it up? Is it down? And then is there a counter trend in place? If there's a counter trend, is it advantageous to trade counter trend? And sometimes it does. Okay. So again, I will decide where are my targets. Every time I go into the market, I make sure I have 4 answers. One is which way the market is heading. Is it up or down? If it's up, I want to buy. If it's down, I want to sell. And then what if I'm wrong? Where do I get out? Always ask this question because you stand an equal chance of being wrong. Okay. So once you pinpoint the price in which if the market move against you, you want to be out, you can actually take a trade. And then again, ask yourself, what if I'm right? Where do I get out? So all this must be within the question itself, before you do your trade. Very simple. The 4 questions: what is the market doing, up or down? Where do I buy? Where do I sell? And if I buy, where do I cut loss if I'm wrong? And if I'm right, where do I get out if I'm right? Okay. So the 4 questions, I repeat again: direction, okay, and where to enter, where to enter a trade, okay, and then if I'm wrong, where do I get out? If I'm right, where do I get out? So if you have answer consistently to every scenario, this is basically the all four possible things that you can look for. If you get question, if you have answers to these 4 questions, you can basically do any trade. And I do have my way of looking at things very differently from maybe other traders out there. So if you want to know more, come back to me. You can always find me on Facebook. We can discuss about this.
Yeah, okay. So I think, Nicholas, yeah, if you have other questions regarding on TA, maybe you can contact Daniel. All right. Okay, maybe I have just one last question. Okay, so with the state of the US economy right now, right, and if whether, the Fed will likely to raise any interest rate going forward, or if we will see any recession coming, how does it impact the gold or silver prices? Should investors start buying gold now?
Oh yes, I can show you the gold chart. Okay, actually I prepared to show you the gold chart, but because of time constraint, I didn't do that. Now let's go to this. Okay, this is the continuous futures. This is the weekly time frame. So if to answer your question, Abigail, the market is in a bull phase, meaning to say the market is likely to go higher rather than go lower. And my target is for a move towards $2,500 per ounce. Okay, right now, of course, the high trader is only just above $2,000 per ounce. And right now we have a pullback. We have a triple top here. So right now we are possibly seeing some near-term weakness. So if this market continues to trade lower, I won't be surprised. And how far can it go? I think there's a possibility the market will unfold in a 3-wave targeting, maybe as little as $1,891, if not $1,852. So I'm looking to buy. So I'm very bullish on gold, and the bottom in gold could possibly be in place this month. We only have 2 more weeks to go before the June is over, and I do strongly believe a low will be in place this month. So I'm looking for a level to buy because my long-term outlook of gold is so bullish. It's going to blow up the highs to all-time high. Okay, so I am actually very, very bullish.
Okay, thanks. Thanks for the possible opportunity on gold. Okay, so yeah, I guess because of time, I think that will be all for our Q&A. Maybe Daniel, could you just show your QR code again for your weekly market wrap? Because some of them might want to do a screenshot on this. Yeah.
Just Google search me on Facebook. You can find my page, and then I will always do a small write-up on Saturday morning, maybe on Saturday, maybe late afternoon. I will give a market wrap in my Facebook, and followed by the login details for the webinar on Sunday. It's always on Sunday, and it's always the same login.
Okay, all right. Thank you very much, Daniel, for answering the questions. So maybe if that will be all for the Q&A, right? I would like to just share some of the last bit of information for you all. So I will just take over the screen, yeah?
Yep.
Okay, so okay, yeah, just for you guys who are keen to connect with us, okay, you can find us on these platforms. All right, just search Philip Capital St. John Berhad on our Facebook, YouTube, Telegram, and Instagram. We post a lot of updates there regarding our events, promotions, market news and updates, be sure to follow us so that you don't miss out on any of our updates. And we also do upload our recorded videos on our YouTube channel as well. So yeah, make sure you check them out. All right. And then lastly, this is the branch's contact for you to reach out, okay, depending on where your location is. So you can visit our branch or contact us, the branch nearest to you. All right, you can also take a screenshot of this if you want to. And if you have any inquiries, just feel free to call us up or just drop us a message anytime. Okay, so with that, I think we've come to the end of our webinar. So we appreciate everyone for your time. And thank you again, Daniel, for your sharing once again. We hope to see you in our future events. All right, thank you.